You'd assume that small populations and some of the harshest winters in the world would stifle business in the Nordics, right? Well, think again. The reality is that some of the most successful and innovative companies in the world aren't coming from the usual suspects like the US or China, but from these small, cold countries. The four largest Nordic countries, Sweden, Denmark, Norway, and Finland, account for about 1% of the world's GDP and only 0.3% of its population. Yet they have produced an impressive list of corporate giants. From Lego to Novo Nordisk, many of Europe's top firms hail from the region. But what's astonishing is how do nations with such small populations consistently produce such impactful firms? This is the Atlas shift, and we are uncovering for you the unique mix of factors that make this region punch way above its weight on the world stage. From transforming the way we shop to reshaping the music industry, Nordic companies are at the forefront of global innovation. Think of IKEA's revolutionary approach to furniture retail, or Spotify's game-changing impact on music streaming. Then there's Ericsson, a pioneer in telecommunications, and Volvo, setting the standard in automotive engineering. These companies aren't just surviving, they are defining the future of their industries, building a reputation for innovation, efficiency, and resilience that resonates across the globe. Over the past decade, Nordic companies have also outshone their European counterparts financially. In all four Nordic countries, listed non-financial firms have delivered higher shareholder returns than the European average. Today, Nordic companies represent around 13% of the MSCI Europe Index, which tracks the continent's most valuable firms, an increase from 10% just 5 years ago. That puts them on par with Germany in terms of market share, highlighting their impressive financial performance. Nordic companies not only excel within their own region, but also stand strong against global competitors in the same sectors. When comparing the 20 most valuable listed Nordic companies with their international peers, it was found that Nordic firms on average achieved operating margins 7 percentage points higher than the median of their rivals in 2023, with returns on invested capital 5 percentage points higher. What's more, 14 out of these 20 companies had lower debt relative to operating profits, further showcasing their financial health. While their annual sales growth was in line with the competition, the numbers still reveal impressive resilience and efficiency. Of course, not every Nordic company has succeeded. Northvolt, a battery maker, filed for bankruptcy, and Nokia's handset business was overtaken by the rise of the iPhone. Despite these setbacks, the overall performance of Nordic firms is remarkable. The region's natural resources, such as timber, iron ore, and in particular Norway's oil and gas, have certainly played a role. But the consistent outperformance of these companies raises a key question. What's the secret behind their success? One key factor behind the success of Nordic companies is their global mindset, which dates back to the Viking spirit of exploration. For Nordic business leaders, the small domestic market is not a limitation, but a catalyst that forces them to think globally. Among the 10 most valuable Nordic companies, the median share of revenues generated within their home countries is just 2%. In contrast, European companies average 12%, and American companies generate 46% of their revenue domestically. Take Pandora, for example, the world's largest jewelry maker by volume. From humble beginnings with a single store in Copenhagen, Pandora expanded into a global brand in just 7 to 8 years. And today, Denmark accounts for only 1% of its sales. This international outlook has allowed Nordic firms to scale rapidly and thrive in markets around the world, underscoring the importance of thinking beyond borders from the start. Another critical factor driving the success of Nordic firms is their early and enthusiastic adoption of technology. A prime example of this innovation can be traced back to Lego's founder, who shortly after World War II made the bold decision to shift the company's material of choice from wood to plastic, after experimenting with a new plastic molding machine. Although this move cost Lego an entire year's worth of sales, it was a gamble that paid off, setting the stage for the company's future success. Today, this spirit of innovation is still alive and well. Data from Eurostat shows that across the European Union, 45% of companies with more than 10 employees use cloud computing services. But in the Nordic countries, this figure is significantly higher, an impressive 73%, leading the continent in digital adoption. This commitment to technology is one of the driving forces behind the region's competitive edge in the global market. The Nordic passion for technology is also evident in the region's thriving startup ecosystem. Despite its smaller population, Stockholm ranks among the top European cities, with only London, Paris, and Berlin attracting more venture capital. Helsinki is similarly buzzing with activity, home to major gaming companies like Rovio, the creator of Angry Birds, and Supercell, the developer behind Clash of the Clans. This growing startup culture is fueled by a supportive environment for entrepreneurs. Nordic business owners have the confidence to take risks, knowing that if their ventures don't succeed, they are backed by a robust safety net, generous unemployment benefits, and strong public healthcare and education systems. This combination of innovation and security is a key factor that empowers Nordic entrepreneurs to push the boundaries of what's possible. Government policy plays a crucial role in supporting the success of Nordic companies. While high personal tax rates fund generous welfare systems across the region, the corporate tax rate remains competitive, similar to that of the US. Each year, the Heritage Foundation, a conservative think tank, ranks countries based on economic freedom, assessing factors such as market openness, tariff rates, and business regulations. Denmark, Norway, and Sweden consistently rank in the top 10. Particularly in Denmark, labor flexibility stands out. Hiring and firing workers is notably easier than in much of Europe. Additionally, the Danish government's strong focus on digitization has simplified business operations. As the CEO of Maersk, one of Denmark's largest shipping companies, remarked, "You can get a VAT number in a day." In contrast, that process could take months in countries like France. This efficient and supportive regulatory environment fosters business growth and attracts investment. Another key factor behind the success of Nordic companies is the presence of patient shareholders. According to McKinsey, 80% of large Nordic firms have long-term ownership, a stark contrast to just 60% in Europe and only 20% in the US. This long-term mindset is supported by influential business dynasties in the region. For example, Maersk and Lego are still controlled by the founding Møller and Christiansen families, although day-to-day operations are managed by external professionals. In Sweden, the Wallenberg family, whose wealth began in banking, holds significant stakes in major companies like Atlas Copco and Ericsson. Additionally, prominent Nordic firms such as Carlsberg and Novo Nordic companies' governance by non-profit foundations further supports a business philosophy that prioritizes long-term growth and stability over short-term profits. This strategy has empowered them to stay focused on sustainable development, continuous innovation, and industry leadership. These arrangements also protect Nordic firms from being easily acquired by foreign companies, giving them more time and freedom to expand and innovate. In fact, McKinsey reports that 4/5 of listed Nordic companies allocate more resources to research and development than their counterparts in the West. However, this business model faces challenges as Nordic companies' international operations make them vulnerable to geopolitical shifts. The impact has already been felt. In 2023, Carlsberg's Russian operations were seized by the government, forcing the company to sell the business at a significant loss. Maersk, meanwhile, has had its ships and container terminals targeted by Houthi missiles in the Red Sea, which forced the company to reroute its vessels, incurring additional costs and delays. As the global landscape continues to evolve, these challenges will test the resilience of Nordic businesses, but their long-term strategy and innovative spirit are likely to help them adapt and thrive. As global trade dynamics shift, doing business abroad is expected to become more challenging, particularly with the possibility of changing US policies. During his campaign, Donald Trump proposed a 10% tariff on imports from all countries. While the threat has since shifted focus to specific nations like Mexico, Canada, and China, it signals a broader skepticism toward trade that could shape American policy for years to come. This could pose a challenge for Nordic companies, with a third of the revenue from the 10 most valuable Nordic firms coming from the US market. Navigating these turbulent waters will demand a crucial characteristic of Nordic businesses: adaptability. As the CEO of Lego aptly puts it, drawing on Charles Darwin's wisdom, it's not necessarily the strongest that survives, but the one that will adapt to changes. This philosophy has been key to the success of Nordic companies, and as the global business environment evolves, especially with the potential for more protectionist policies in the US, the ability to adapt will continue to be their greatest strength.